In the last 20 years, they've tried it twice before this. Going into 2008's third quarter, when they reduced the balance sheet by in the order of 6-7%. And then we saw what happened with the banks, who were leveraged. So it hurt the banking system because the banking system was leveraged. The banking system is not over-leveraged today. The second time they did it was in 2018, and they hit a 3 or 4% level, I believe, reduction over a 3-month period. And we saw the repo market crack. Rates went to 10%. The whole funding mechanism broke. And they had to step in and did a bunch of overnight and emergency repos. This is the third time. We're only at 1% now, Lawrence. If we get to 3%, it's going to be like terminal. You're going to hear breaking and creaking in the markets. We cannot absorb. What will break? Funding markets. I think that rates will pop up beyond expectation. So the front end of the market is where life happens overnight. And so we can talk about the 10-year, we can talk about even the 2-year, but people fund themselves overnight in the banking system. And if the government and the Fed pushes back securities for, again, the third time in 20 years at a rate they're talking about, which they have not yet achieved, we'll have a problem. And that's the first part of our thesis. There is a problem. The second one is that there's a remedy. We think blockchain is a remedy. We think that it's being adopted, and that it is technology's promise of delivering more for less. And unfortunately, given demographics, given the debt load we have and the slowing economy, third consecutive negative quarter expected. If you look at the Atlanta GDP Now estimate, well, that's one reason why we're spending time on trying to get the message out about digital assets.